One of the largest explosions of a rocket I have seen, maybe that anyone has seen this past week. Blue Origin exploding on the pad. This is a big setback for them, a big setback for the United States, for NASA trying to get to the moon. Daniel, great to see you in person.
Yes, yeah. I dressed up for the occasion. Wore my shirt, yeah.
What I also dressed for the occasion. What do you make of this, in the context of U.S. space policy, SpaceX on the verge of going public, Starlink versus what Blue Origin is working on? Can you contextualize it for us?
Sure. So maybe just to explain what happened. So Blue Origin's rocket called New Glenn was taking its fourth flight. It was conducting a test fire on the stand, and unfortunately it blew up. The most notable thing is that it blew up on stand, which pretty much destroyed its whole launch complex for the most part. And that was the thought at the time. Why the timing was unfortunate is just 2 days before New Glenn or Blue Origin got like a $470 million contract from NASA to deliver vehicles to the moon in 2028. So at the time, a lot of commentary was saying that, the damage that they could see from imagery looks like it'll probably push the nearest launch out by at least a year, because it was their only operational launch pad. However, thankfully today, the CEO, Dave Limp, came out and said that it looks like a lot of the long lead items for the complex are actually still intact, and he's optimistically confident that they can launch towards the end of this year. So that's what happened, and then maybe just some quick implications, and I'm sure we can go back and forth. But firstly, it really just shows that vertical integration is important, because there's a lot of satellite providers that were really relying on launch providers, which is already a constrained market. Amazon's Project Leo already came out a couple of weeks or months ago and said, we're building so many satellites, but we can't get launch vehicles. So it was pretty heavily reliant on New Glenn. It was also playing an important role in NASA's mission to get back to the moon. So contingent to see how long that'll be delayed based on the 12-month, and then also just the industry falling back on SpaceX and again, and reliance on the Starship program. So a lot of kind of implications, but they're kind of the first takes so far.
Yeah, I don't know if it's actually necessarily even good for SpaceX. As in, I think SpaceX, particularly Falcon Heavy, can potentially take some of the volume that otherwise was going to go to New Glenn. But SpaceX has a lot of execution in front of it and huge return on capital potential in just building Starlink satellites, sticking them in the Starship rocket, getting that reusable and launching it. And the space business is in a capital efficient way to produce launch vehicles, I think is a good way to think about it, and to fund R&D for launch. But they don't necessarily want to have to devote resources and bandwidth to picking up some of the schedule that would slip from New Glenn in Falcon Heavy, just because they have such an amazing set of commercial prospects on the other end. So I do think it's really good news, I think, for SpaceX and for the industry as a whole. If Blue Origin can launch again within a year, that would be very, very, very positive relative to what we were anticipating based upon the tremendous, Oppenheimer level Christopher Nolan IMAX camera explosion that was on the launch pad,
Question for OE. What and how many launch facilities are active in the U.S., or how many does SpaceX have?
So in terms of active, I don't know off the top of my head. SpaceX has, I know it has maybe 4 or 5. You know off the top of your head?
Well,
It depends on what rocket they use.
And they're constructing a number,
several
more for Starship.
Yeah.
This was
Right.
Blue Origin's only.
Only operational. They're constructing one actually close by to it, and then another one in Vandenberg, California. But again, they wouldn't be ready within 12 months. I think the thought is that they'll just rebuild what was destroyed.
In our modeling, SpaceX needs to build on the order of $8 to $10 billion of launch pads over the next couple of years to support the Starship. And these launch pads are really expensive. And there's no better evidence than what ULA was trying to do, where Bechtel had this contract for, I think it was a couple $100 million, and now they've spent a couple $1 billion, and they haven't completed a launch tower for kind of the United Launch Alliance. And SpaceX obviously is doing it cheaper because they're not on a cost plus contract. That's actually their own money they're spending. But the SpaceX launch towers are not only like launch the rocket, but also catch the rocket and put it back on the stand. And so these are very, very hard, long construction projects built in multiple places.
Yeah.
So
that's why Elon has said in the past, like a successful launch, particularly like the most recent Starship was their first one on the new pad. It can blow up, just blow up in space. Don't blow up on the complex because it just delays everything by months, if not years.
No, I assume they're also not interoperable, as in like Blue Origin can't say, hey, Elon, can we use your launch?
No. That's purely by rocket size. So the New Glenn can launch around 45,000 kilograms per launch. The initial Starship is 100,000, eventually going to 200,000. So different rocket sizes.
Yeah.
And it is worth noting, one, it's great. No one was injured.
Yes.
Two, it's particularly sad. Blue Origin is the only other company that's landed a orbital booster.
Yep.
Right? And that's 10 years behind SpaceX, but second place nonetheless.
Yes.
And now there's this setback. What do you think is going to be the implication for all of the people and satellite companies now? I think that's kind of the bigger impact where already, as you mentioned, it was constrained. Mm-hmm. Do these small companies have the balance sheet to handle another burn rate of, I don't know, another year plus?
Yeah. I think for launch providers, at least, like in the public market, there's Rocket Lab. Their current rocket is called Electron, but it's only 300 kilograms roughly per launch. They are developing Neutron, which is around 13,000 kilograms. So again, still significantly smaller than New Glenn. So that wouldn't have the capability to going out to deep space and to the moon. But it's likely you'll see probably a lot more companies come to the public market to get the equity to learn and iterate. Stoke Space is another interesting company in the private market. They're the only one kind of leapfrogging the partial reusability and going to full reusability. But to Sam's point, why it was such a blow is because Blue Origin, it's the only company who's landed the booster outside of SpaceX anywhere in the world. So that's why it was just so notable, given how constrained the market is right now.
Shifting gears here, Brett, unless you have any other explosive comments.
No, let's shift.
Okay. SpaceX S1A out. NVIDIA number of GPUs as part of the $15 billion annual contract. You've done the math. The internet's done the math. But you've got a response from Elon. What's your
a correction?
Yeah.
Carried away, Brett.
Yeah.
But can you break down how much context does that number of GPUs provide? What does it mean for SpaceX, which I think is arguably less important than what it means for the industry? And so if you could break that down for us.
Sure. So there's this in the S1 and announced by Elon, Anthropic, maker of Cloud, was renting GPUs from SpaceX XAI, which has its Colossus 1 and Colossus 2 data centers. And the S1 revealed they were going to pay $15 billion a year annualized for that rental. But we didn't know how much of those data centers were being rented. So for context, if I go out into the market and ask for GPUs sometime in the future for rental, I might pay $15 billion per gigawatt for those GPUs. The reason the likes of Anthropic are willing to do that is if they take the GPU and they convert it into tokens, they can charge something on the order of $30 billion per gigawatt, maybe even 40, maybe even 50. We don't know exactly what's going on financially behind the scenes for Anthropic and OpenAI, but tokens are very valuable right now, and people are willing to pay a lot for them for digital intelligence. And so that's the business model of these frontier model companies. And the amendment to the S1 allows us to estimate that at a minimum, Anthropic was paying 25 billion per gigawatt, but probably more like $30 billion per gigawatt to rent the GPUs. So call it 2x the market rate if you wanted to go out a couple years and try to secure compute. And you probably can't even get it a couple years forward. So the reason they're willing to do this is because they've signed up all these customers for Claude, but the customers are upset that Claude isn't always available, and they're having to dumb down the models in order to serve the customer demand. So they literally need more GPUs to retain and service the existing customers they've already signed up. In fact, you could argue that their revenue growth is constrained not by demand, but by the amount of GPUs they have. So if you do, the other thing to note about these data centers is SpaceX is somewhere around 30 and even more % more capital efficient in building data centers than the industry. And so the SpaceX is not only able to charge like a higher than market rate to give Anthropic short-term GPUs, they also spent less capital building the underlying infrastructure that they are monetizing. So if you said, hey, this contract's going to last for 5 years, it would actually produce net $50 to $60 billion in cash to SpaceX just on this, data center that they have. Now, Elon's response was, this is a short-term deal, which is true. Like by contractually, it's basically like either party has the ability to be like, I'm out. And I think it's 90 days, maybe even less, that they have to give notice of like, no, we're out. And so I think from Anthropic's perspective, they had a short-term need. They're willing to pay over the market. If they can line up better compute capacity, they'll swap out of this into a different deal. And from SpaceX's side, they have Cursor that they're going to, presumably acquire. They have an option to acquire them. And they have a lot of compute training needs so that they can themselves compete on a monetization front with the frontier model providers. And so they might want to call the compute back because they need it for training purposes. So those are the two reasons to believe that neither party is going to stay in the contract for a long period of time. I think it's safer to say you build the computer, you build the data center, and you rent it out for a year and you get the data center for free. Maybe it's not going to be a full year, but that's the way the rough math works out. And it's also a sign that it's really good to be a company that can very efficiently and quickly put compute infrastructure in place in a world that is net short of compute infrastructure.
And then the other news is that Anthropic has publicly, confidentially filed to go public.
I think it's publicly filed I think confidential was in the wrong space in that
Publicly
sentence.
announced a confidential filing.
Yes, thank you.
Right, I'm curious, just in terms of, do you think that the rest of the market understands the economics you just laid out from the data center side? Because we also had, I think Alphabet is in the market trying to raise $80 billion in equity for future AI build out, but the stock is, if you look, it's selling off on the news. And so I'm just curious if you think others appreciate the economics and the back end monetization that these data centers provide.
No, I don't think that they do. I think Alphabet's shareholder base is kind of maybe a little queasy stomached to say that this large cash flow generating business is selling off a piece of equity to like invest more. I thought we had plenty of cash flow. So it could be, the shareholder base itself is not kind of like prepared for this. And that's a sign that kind of the market as a whole, maybe they kind of believe the economics on a short-term basis, but they're worried about what are these assets worth 3 and 4 years from now. Now, right now, the demonstrated kind of like monetization of these things is much higher than people were anticipating when they originally underwrote the data centers. Meaning, the underwriting model was on like these chips last maybe 4 or 5 years, and then that's it. And the reality is, it looks like the chips are going to continue to monetize, long after their rated life, because you can have, dumber agents running on those chips. You can actually parse out kind of pre-fill, where the AI model is interpreting a bunch of data in parallel, and decode, where it's actually generating the results for you. And you can run that pre-fill on less expensive chips because you can do it in parallel. And so there's lots of ways in which these chips are turning out to be useful for longer, and so then have a better monetization curve. If that trend continues, which we think it will, then kind of the return on capital for investing in data centers and renting them out is very, 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 very positive. And so, yes, I think the market doesn't really get it or believe. I think they believe we're short compute today and tomorrow, and they're worried we're going to be oversupplied of compute 3 years from now. Is probably like the rough math.
And maybe we don't want to go down this rabbit hole, but I think worth at least asking you, Brett. There are questions out there, and I think Michael Burry is out there beating the drum around off-balance sheet financing that some of these companies are using to fund some of this build-out. Do your numbers for SpaceX, XAI factor in any of those vehicles that are being used, or and what do you make of that structure? Because he's calling it an outright fraud. I don't know entirely what to make of it. So I'm curious if you have thoughts.
I mean, I may defer to Daniel here in a second, but SpaceX did lease some of its data center, but our interpretation of the financial statements is those do appear in the CapEx numbers because of the way the lease is treated by GAAP accounting standards. And so they are fully on balance sheet. And also to calculate the capital efficiency of SpaceX, particularly on the data center line, we've gone about it in a few, like we look at the CapEx line and we look at property, plant and equipment. So we've gone about it in a few ways, triangulating to make sure we're not misstating their capital efficiency. And it looks like they triangulate successfully. Daniel, thoughts?
Yeah, the in the S1 is a transaction. It's called a failed sale and leaseback, where I think it's Valor. Yeah. And in theory, because they've sold it and they've leased it back, they haven't necessarily transferred control, even though on paper they have. So from an accounting perspective, they keep it on their books.
Right. Okay.
So that's why you can kind of look to their PP&E as a rough gauge, despite like on paper the fact that they don't physically own the building anymore.
Yeah,
and that's exactly to kind of prevent all that fraud from like pulling it off your books, even though in practice you're actually still using it.
So not the Big Short part two.
Yeah.
I think that the fact that Google is raising equity capital and the fact that these data centers have thus far largely been funded by equity is, though there is debt financing of data centers, don't get me wrong, but there's like a big chunk of equity going into data centers. Plus the rate at which data centers are being built is constrained on the one hand by chip supply and how quickly Taiwan Semi is willing to increase its, foundry, and on the other hand by power supply and, how quick people can line up and plug these things in to power. Those are both kind of supply constraints that are keeping the cycle in check thus far. And then there's like you have to simultaneously believe, hey, there's all this off-balance sheet financing going, and we're at the end of the cycle, as in 3 years from now, there's going to be too much of this stuff and we're not going to know what to do with it. And I think on a mixed basis, both of those are wrong. I think like the demand story, I think is actually much more profound than people understand, and most people haven't tried to dimension it. They're just like, no way there's this much demand. I read Gary Marcus and he says these things are going to hit a wall, and on the supply side, I do think that there are like other factors that are constraining things. And there's not yet so much kind of like financing risk. At some point, but not today, at some point we will be in there's a lot of this stuff happening, much more than can be stomached by the market in the near term. And then you will see, and even on the demand side, you could see like businesses being like, oh, we're spending a lot of on tokens. Are we getting enough productivity out of it? They don't even need to change like the amount that they're spending. They just need to like say that in a loud enough way, and people will get really freaked out. And there will be like a bunch of like market correction type stuff. But I think that measured over 2 and 3 years, this is going to be continued, a lot of demand and amazing revenue generation.
All right. Thank you, Daniel. Thank you, Brett. Thank you, Nick.
Thanks
See
everyone for
everyone
watching.
next week.
Yes. Yeah.
It's a good go around the room.
ARC Investment Management LLC is an SEC registered investment advisor. ARC, Wolf Financial, and Public are separate, unaffiliated entities and do not have a relationship with respect to any company marketing or selling the products or services of the others. ARC, Wolf Financial, and Public make no representation or warranties regarding and expressly disclaim any responsibility or liability for any acts, omissions, losses, or damages of the other entities or their affiliates, officers, employees, or agents. No company shall be liable for any indirect, incidental, consequential, or special damages arising out of or in connection with this podcast or its contents. The information provided in this show is for informational purposes only and should not be used as the basis for any investment decision and is subject to change without notice. It does not constitute either explicitly or implicitly any provision of services or products by ARC, and investors should determine for themselves whether a particular investment management service is suitable for their investment needs. All statements made regarding companies or securities are strictly beliefs and points of view held by ARC and/or show guests and are not endorsements by ARC of any company or security or recommendations by ARC to buy, sell, or hold any security. Historical results are not indications of future results. Certain of the statements contained in this show may be statements of future expectations and other forward-looking statements that are based on ARC's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statement. ARC assumes no obligation to update any forward-looking information. ARC and its clients, as well as its related persons, may, but do not necessarily, have financial interests in securities or issuers that are discussed. Certain information was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of any information obtained from any third party.